Welcome to the Explainer. Today, we are doing a deep dive into a really fascinating piece of real estate right in the heart of Kuala Lumpur, Stonor 3 KLCC. There's this old saying in property investing, location, location, location. And you think, hey, buy in a prime spot in a major capital city, and you're pretty much guaranteed to make money, right? Well, as we're about to see with today's case study, the reality, it's often a whole lot messier than that. So let's zoom in on Stonor 3. It's a luxury freehold apartment that was finished up back in 2019. And it's smack dab in Kuala Lumpur's Golden Triangle, the super prestigious KLCC area. I mean, on paper, this place has got it all. But when you look at the numbers, they tell a very, very different story. So what makes it so complicated? Well, Stonor 3 is a true investment paradox. It's really a story of two totally opposite results, and it all depends on what you, the investor, are actually looking for. And this is the heart of the issue right here. On one side, this property is an absolute star when it comes to generating rental income. We're talking a real cash flow machine. But on the flip side, it's a huge underperformer when it comes to its market value actually going up. It's a classic tale of two completely different returns. Okay, so let's kick things off with the good news. What exactly makes this property such a rental powerhouse, especially in an area as competitive as KLCC? It all boils down to this number, an estimated net rental yield of 4.5%. Now, for a high-end property in this kind of market, that is a very impressive figure. It makes it an incredibly tempting asset for anyone who's focused purely on getting that monthly cash flow.
So why is demand so strong? Well, it's not just one thing. It's the whole package that creates this powerful magnet for high-paying tenants. You've got the freehold status, which is a huge plus for long-term security. The sheltered walkway to the new MRT station, that's an absolute game changer. And, the build quality is top-notch, thanks to a fantastic Japanese-Malaysian joint venture.
So who's willing to pay a premium to live here? We're not talking about local families. The target tenant is almost always a high-earning expat or a corporate professional. These folks want smaller, fully furnished units that are ready to go from day one. And they will absolutely pay for the convenience of being able to walk to embassies, their offices, and huge lifestyle hubs like Pavilion. That very specific demand is what keeps the rental income so strong. But wait a minute. With such a great rental story, you'd expect the property's value to be soaring, wouldn't you? So why isn't it? Well, that brings us to the other side of the coin, the capital growth problem. This chart, well, it tells a pretty painful story. On the left, you see the developer's original launch price, which was floating around 2,000 ringgit per square foot. But that bar on the right, that's the reality of today's resale market, a median price of just 1,533. For a lot of the original buyers, that means they're looking at a pretty big loss, at least on paper. So what's the core reason for this? It's pretty simple. The KLCC area is just flooded with competition. You have these massive neighboring projects, like 8 Conlay and the Conlay, that are dumping thousands of similar luxury units onto the market. That puts a really hard ceiling on how much prices can actually grow. It's a classic case of supply just crushing demand. And the pressure isn't just from the outside. Owners also have to deal with this number. The monthly maintenance fee is 55 cents per square foot, and that acts like what we call a yield compressor. It directly eats into those strong rental profits we were just talking about, squeezing the actual net return for the owner every single month. And the hurdles just keep coming. Yeah, it's centrally located, but the main roads around it, like Jalan Tun Razak, are an absolute nightmare during rush hour. The property also sits on commercial title land, which means higher bills for things like water and electricity. When you add all this up, it means that for the next 5 years at least, any capital gains are probably just going to keep pace with inflation, and that's the best case scenario. So, what on earth does all this mean for you as a potential investor? Look, the answer isn't a simple buy or don't buy. It really comes down to one crucial question. What kind of investor are you? This little scorecard basically sums up our whole analysis, so let's see where you fit in. If your number one goal is steady, predictable monthly cash flow, Stonor 3 gets a solid A. It's an excellent tool for that job. But if you're in the game for capital growth, for the value of your asset to go up, it gets a D. It's just a poor choice for that goal. And what if you want a bit of both? Well, that's a risky C. The weak growth prospects really outweigh the strong yield, making it a tough balancing act. And that leaves us with this final big question. Is Stonor 3 a stable cash cow that just churns out reliable income month after month? Or is that attractive high yield actually a trap, hiding an asset that's just stuck, never really growing in value? The answer, as we've seen, isn't really about the property itself. It's about your portfolio and what you, the investor, are really trying to achieve.